Good morning.
There you go.
Nice. As Mark said, my name is Cory Ouellette. I'm a shareholder with Elliott Davis. We're a business advisory firm headquartered here in Greenville, South Carolina. I'm in our real estate practice and have been leading the firm's initiative on opportunity zones for the past year and a half. So I'm really going to look at this from a tax perspective over the next 30 minutes. And I know we have a broad range of attendees, some who have probably new to opportunity zones, some who have been dealing with it for a year and a half as well. So I want to make sure everyone has a base understanding of the tax benefits. And hopefully everyone's comfortable. If you have a question, we're willing to take questions. So if you're comfortable asking, please ask away. We've got an iPad up here with the Slack app open. So if you want to ask a question via that method, I'll try to monitor that. And to make sure I don't bore you with tax talk for the next 30 minutes, we have CitySculpt here on stage as well. This is actually Mike Miller is filling in. Mike is the CFO of CitySculpt, and he'll be looking at it from a developer's perspective. And I'm sure if you have questions for him, he'd be happy to answer them as well. So really want this to be conversational, hopefully. And I think if you have a basic question, feel comfortable asking it. If you have a technical one, I think we'll feel comfortable trying to answer them. And the better understanding you have now over the next 30 minutes, I think will make the rest of the day more valuable to you. So opportunity zones. We know it's a tax incentive to drive investment into low-income communities. So what is that tax incentive that's built into the program? I really look at it from three perspectives, in that there's three different benefits that you can achieve by investing in a qualified opportunity zone fund. The first one's gain deferral. Second one's partial forgiveness, and then additional forgiveness on exit. So gain deferral, what does that look like? So if you have a capital gain event and you invest in a qualified opportunity zone fund within 180 days, you can defer that gain to the latest 2026. Now, if you sell that opportunity zone investment before 2026, the gain becomes taxable at that point, but the latest you can defer that to is 2026. Keep in mind, to take advantage of all these benefits of the opportunity zone incentive, you do have to have a capital gain event to begin with. You can't invest after tax money. So that capital gain event can come from sale of publicly traded stock, come from a sale of your business, come from a sale of real estate. Any kind of capital gain event is required in order to take advantage of all the benefits. Second bucket of benefits is that partial forgiveness. If you hold that opportunity zone investment for at least 5 years, you eliminate 10% of that gain that you previously had. You hold it for another 2 years, so 7 years total, you eliminate another 5%, so 15% of that gain is eliminated. Again, as I pointed out in the first bucket there, that remaining 85% would then be taxed in 2026. And the third benefit, in my mind, the best benefit of the program, and what I believe will actually drive the success of this program long term, is the 10-year hold benefit. So if you invest into an opportunity zone fund, you hold that fund investment for at least 10 years. After you sell that investment, when you sell that investment 10 years after holding it, or after acquiring it, your basis stepped up to the sales price, which basically means you don't pay tax on that gain. So I do want to point out, because I think it's kind of lost in the shuffle, we have two different gains that we're dealing with here. Like I said, you have that gain unrelated to an opportunity zone, gain from a publicly traded stock, from selling real estate in or outside of a zone. So a simplified example, let's say it's $1 million gain. You don't want to pay taxes on it in 2019, so you put it into an opportunity zone fund within 180 days. You are not paying tax on that. You hold this new investment within the opportunity zone fund for at least 10 years. 9 years from now is 2026. You'll pay taxes at that point on 85% of that million, so it's $850,000 of gain that's getting taxed. The opportunity zone investment, you put in $1 million originally in 2019. You hold it till 2029, 2030. Hopefully that asset that you invested in has appreciated since your initial investment. That $1 million hopefully grows to $2 million, $3 million, $4 million. That appreciation from $1 million to your exit price is fully tax-free. There are some nuances built into all those, but like I said, won't get into the details unless, of course, anyone has any questions about that. So for the next couple of minutes, I want to look at this from two perspectives, one from the investor who has the capital gain event, and then the other perspective from the fund who's taking in equity and developing assets or businesses within the zone. So as I pointed out, you have to have a capital gain event. Do want to note that you don't have to defer, or you don't have to reinvest the entire gain. You could choose to reinvest a portion of it. So if you reinvest 75% of your gain into the fund, then 75% is deferred, 25% is taxed. One other item to point out on that is to defer 100% of the gain, you only need to reinvest the gain amount, not 100% of your proceeds. So if you sell real estate for $1 million, say your basis in that was $600,000, you have $400,000 of gain, you don't want to pay tax on any of it. You don't need to reinvest the $1 million, you can just reinvest the gain of $400,000. So your basis for that principal of $600,000, you can take off the table and do with it, invest it somewhere else, spend it, whatever you wish, but you can still defer 100% of the gain by only reinvesting the gain amount. A third requirement from an investor's perspective is it must be reinvested within 180 days. So you can take receipt of that cash from the initial gain, hold on to it for up to 180 days. At that point, you need to get it into a qualified opportunity zone fund. At 180 days, you think that would be straightforward, but it's tax law, so of course it's not. The 180-day measurement period starts, depending on how that gain was initiated, starts at different points possibly. If you sell stock in your portfolio that you hold directly, you have 180 days for when that transaction occurred that generated the gain. If you happen to hold investments through a partnership, whether it's real estate held in a partnership or stock in a family limited partnership, you have 180 days from the year end of that partnership. So typically you have a calendar year tax-paying partnership. So you, the partner, would have 180 days from 12/31 year end. The reason for that is sometimes, depending on what your ownership is in the partnership, you might not know what your gain amount is until you get that K-1 at year end. So they've deferred that window of 180 days to year end, hopefully allow you to get from your CPA, your tax preparer, that K-1, maybe March timeframe. At that point, still have 3 months to reinvest it, so 180 days from year end. One thing I've seen that's kind of caused a hiccup on this one unintentionally is typically in a real estate deal, if you sell your main assets, there's no need to keep the partnership open. So I've seen some people who have sold the asset maybe in March, February timeframe. They think they have 180 days from 12/31 when the partnership year ends, but they go ahead and liquidate in June, not thinking, hey, that June liquidation of the partnership starts the 180-day clock. So something to be aware of there. Looking at this from the Qualified Opportunity Fund and how this is executed once they receive equity from investors. So Qualified Opportunity Fund, that term there kind of scares a lot of people away. They think, a fund, I need to look to a third party, I need to look to a governmental entity for a fund to invest in, but any taxpayer can create their own fund like they would any other LLC or partnership. Like Senator Tim Scott said earlier this morning, the plan was to keep this program as simple as possible, which is almost laughable when I get into the law, but the intent is to keep the barrier to entry low, and that they don't want to get governmental entities involved to manage the fund. They do want any taxpayer to be able to create their own fund, and that is the case. So with your initial tax return, you file some additional paperwork to self-certify that your partnership or corporation is a fund. So in addition to that, the fund itself, to be qualifying, right? You want to be a qualified opportunity fund, you don't want to just be a fund. You have to hold at least 90% of your assets in qualified opportunity zone property. So what is qualified opportunity zone property? It can be qualified opportunity zone stock, qualified opportunity zone partnership interest, or qualified opportunity zone business property. So it all seems pretty redundant, but I'll try to explain the difference here. What this is showing you here is that the fund itself that third item there at the bottom, the fund itself has the option to invest directly into the business or the real estate, or the fund can invest in a partnership or corporation, a subsidiary, if you will, that in turn then invests in the qualifying assets. Those first two are what I call the indirect method of investing, whereby the fund invests indirectly through another entity into qualifying assets. And I'm sure later today when we have our attorney panel, we'll get into more of the details on this. That third bullet point there is the direct method, again, where the fund owns the assets directly. Surprisingly, I'm not sure if this is the intent or not, but depending on how you structure this, does change your compliance requirements. You might have heard there's a 90% test, a 70% test, a 50% test. All those tests are calculated differently depending on how you structure this up front. We jump back. So to be a qualified opportunity zone stock or partnership interest, number one and number two there, you have to invest in a qualified opportunity zone business. All right, so at the end of the day, the assets need to be qualifying. It's just layering down from a fund down to a subsidiary, down to the actual assets and what those are. And here are some of the tests that go along with that. You have 70% of the tangible property must be in a qualified opportunity zone, or excuse me, in an opportunity zone, obviously, right? At least half the income must be derived from an active trade or business within the zone. Less than 5% of your assets can be financial instruments. So you can't you can't become a day trader sitting in a zone and forego capital gains tax. It needs to be tangible, real assets, not financial securities. And it can't be what they call a sin business, which those businesses listed down at the bottom, if you can read it, were taken from the new markets tax credits section of the tax code, and they just piggybacked off that. The property that's held by the qualified opportunity zone business, there's a couple of requirements here. Just touch on them high level. You have to acquire the property after 12/31/2017. So if you are a business owner or a landowner that owned property in the zone prior to 12/31/17, there might be some benefits you can get. It'll be a little more difficult. You have to get a little creative in the structuring, but just generally speaking, you would not qualify. During substantially all the fund's holding period, all the assets must be used in the opportunity zone. And then that third requirement is an or requirement. The original use of the property must commence in the zone with the qualified fund, or you must substantially improve the property. So the real estate, looking at this from the real estate perspective, I think is the easiest way to kind of reflect what this is trying to accomplish. Real estate's always been in the zone, right? You can't move real estate. So even before zones exist, opportunity zones exist, the real estate was in it. So the real estate, it's by that nature, can't qualify there for original use of the property, must commence with the fund. So that's why we have a substantial improvement requirement that allows real estate to become a qualifying asset if you substantially improve it. And to substantially improve it, to meet that definition, you must double your initial investment in the real estate to improve it. Or if it's an existing business that has assets, you must double the initial cost of the assets you're acquiring for them to be considered improved. Now, if you're a new business that's never been in operations and you're opening up in the opportunity zone, you don't have to worry about that substantial improvement requirement because the original use begins with the fund in the zone. Or if you're an existing business that's outside the zone, you pick up and move your assets into the zone, then you possibly don't need to substantially improve those either. So that's the tax perspective. I'm going to turn over here to Mike, and he can talk about what Citysculp's doing in the opportunity zone space, talk about it from a real estate developer's perspective, and talk about a project here in Greenville.
Where's the up here? That one? Okay. Yeah. Good morning, everyone. The simplicity of the tax code is sort of a misnomer here, and Citysculp, before any of the funds that we developed, we have used Cory and his firm, and we owe you a deep, deep sense of gratitude for all your advice and counsel. It really comes down to a couple things. First is that no two taxpayers are alike, and no two funds are alike. So seeking qualified tax counsel is essential as you think about opportunity zone formation and opportunity zone execution. Cityscope has been around for quite some time in the Charlotte area, doing projects in both North Carolina and South Carolina. And our tagline and our brand imaging has been shaping cities and improving lives. And the Opportunity Zone legislation that came out in 2017 is reflective of what we have done in the past, of a great deal of urban infill projects that takes a great deal of vision, a great deal of courage to execute, but we have been building multifamily, retail, office buildings in what currently look like opportunity zones, but at the time we're not. We've petitioned the government to go back and recertify them, but that's, as Senator Scott said, the rules are pretty firm and not going to change. We offer lots of asset classes that range from multifamily to student housing, senior housing, retail, and certainly office buildings. Our Opportunity Zone investments currently are we have about 15 to 20 at any given time. We're looking at Opportunity Zone investments. For our Opportunity Zone target areas, we're looking at market rate multifamily. We're looking at impact rate multifamily, which would include an element of affordable housing, as well as municipal projects. Many municipalities and governmental entities are looking at using their investments that they have in opportunity zones to leverage new projects, whether they range from parking facilities, water treatment facilities, and using that private-public partnership to draw outside capital to get some of their projects completed. This is a pretty busy chart, but there's a couple of things to consider as you're looking at investing in Opportunity Zone funds. And I really want to go to bullet number 7. Again, these are very complicated matters that require both legal and tax consultation to really understand the impact that you will receive as you make these investments in qualified Opportunity Zone funds. And also the experience, number 2, the bullet point number 2 is experience with Opportunity Zone funds and fund development. And again, firms like Elliott Davis and Cory have been instrumental in providing that tax foundation in terms of rolling out these Opportunity Zone funds. Currently, we have 2 funds right here in Greenville, South Carolina, Fund 1 and Fund 2. Fund 1 is a development project that includes an existing office building that's often referred to in Greenville as the AGFA building. It's a building we own. And associated with that, Fund number 1 is that existing office building, as well as a 263-unit multifamily complex with a parking facility that's embedded in it. And that's about a $72 million project. And within that, within the multifamily, there is a workforce housing component that has about 22% of the units allocated to workforce housing. A couple of things about that particular multifamily project: it is built on currently vacant land, so we're not displacing any homeowners. And it's also providing workforce housing to the Central Business District of Greenville, which we think is an enormous addition to the landscape of the Central Business District. And it also addresses something that Senator Scott talked about, which was the transportation hurdle that many of these projects have. And this is really 2 blocks off of Main and McBee. So it provides a pedestrian-friendly environment for downtown workers. Fund number 2 on the right-hand side of that slide is a new office building on the corner of McBee and Academy. And it's in response to a great deal of inbound inquiries and inbound investment to support the Qualified Opportunity Zone businesses. And attracting Qualified Opportunity Zone businesses to the Central Business District that can benefit from that 10-year hold that Cory talked about, that the appreciation in the business in a leased facility over 10 years has a 10-year exit tax-free. It's an incredible part of the legislation that Senator Scott and Senator Booker had related to the foresight and attracting these businesses to opportunity zones. Probably can't see that, but it's on the corner of McBee and Academy here in Greenville, if you're familiar with the area. It's going to be a live here, work here environment. We're about 1/8 of a mile off the Swamp Rabbit Trail, and we are 2 blocks from the new proposed convention center that's going to be along the Reedy River. We can talk a little bit about the after-tax model, but again, no two taxpayers are alike. And generally, from a project level to an after-tax level, there's somewhere between 1.5% to 3% uplift in terms of internal rates of return. You will see and again, it really depends on who the taxpayer is and how the fund is structured.
Now, you may go back to that slide and just kind of jump in for a moment. So typically when investors are looking at their investment options, they look at IRR, and typically that's as a pre-tax IRR. Here we have an opportunity zone program that's a tax benefit, so we're stuck with trying to force a after-tax benefit into what typically has been a pre-tax IRR calculation. I've discovered over the past years multiple ways kind of to try to slice that up and reflect that in a model. So the project level IRR here, 13.2, and after-tax, 14.7. Typically after-tax IRR is less than your pre-tax. But what this is trying to highlight, like Mike says, that bump up in the return because the capital gain exit is tax-free. So this, I don't think is capturing the operations, the ordinary income that's earned over the life of the project. It's just showing that 15% gain forgiveness on your gain outside the fund, and then the benefit of that tax-free exit once you exit the CitySculpt project.
And again, no two taxpayers are alike, and I can't emphasize enough getting good qualified tax advice. This is an eye chart. We'll kind of move on from this, but it demonstrates the uplift that you'll get from an after-tax return. In terms of Fund 1, we hope to break ground in Q1 of 2020. That's the multifamily and the parking project. We hope to complete that project by the first quarter of 2022. And 2030 is the expected life cycle for Opportunity Fund number 1. Opportunity Zone Fund number 2 is the office building on the corner of McBee and Academy, and that's scheduled to break ground sometime in the first quarter of 2021. And that has a fairly rapid development cycle, opening hopefully in Q1 of 2022. And again, that 10-year hold is running out to 2031. So those funds are alive. Those funds we're building capital stack as it relates to it. And hopefully we're on progress with the city and the county to get through the design review, hopefully before the year end. So we think we're on track.
I guess one comment on that timeline as it relates just to funds in general. To get the full benefit of the program and that full 15% gain forgiveness, you have to be invested in the fund for 7 years prior to 2026. So for that to happen, you need to be invested in the fund in 2019. Now, if you invest in 2020, 2021, you still get the 10% forgiveness, the deferral, and the 10-year hold, tax-free exit. So you lose that 5%. So you can't invest after 2019 and still take advantage of the bulk of the incentives, but you do lose a small 5%. Another item to point out, quickly hit on it, is capital gains and 1231 gains are treated differently. So 1231 gain should, at the end of the day, get taxed as a capital gain, but you have to net all your 1231 gains together before you know what your amount is. Capital gains, Treasury said that you can invest the gross amount. So if you have a $10 million or $1 million capital gain and a $200,000 capital loss, you can invest the $1 million capital gain into a fund and it's all qualifying. You don't need to net it with that loss. 1231s, excuse me, are different in that the only qualifying equity would be the net amount. So if you had a $1 million 1231 gain and a $200,000 1231 loss, your net amount's $800,000. So if you end up investing $1 million into the fund, 80% of that is qualifying and gets the 10-year benefit, 20% is non-qualifying. If you'd want 100% of your equity investment to be qualifying, you could only invest, in this case, $800,000, the net amount. And you don't know, as a taxpayer, you don't know what your net amount is until the year's up, right? So if you have a 1231 gain, doesn't matter, generally speaking, does not matter if you sold that asset January, February. If you sold it personally or through a partnership, you don't know until year end what your net amount is. So your 180-day period would start at year end. So you cannot invest it March, April, May through December. Now, they did say that the netting is known as a 1231. So if you have a 1231 gain and you want to get into a fund before 2019's up to get the full 15% gain forgiveness, you have literally December 31st as your only day to invest that 1231 gain. So make sure you give your attorneys a heads up and let them know that you'll be, or your fund sponsors a heads up that you'll be contributing equity on 1231. December 31st with your 1231 gain.
Quickly, my partner, Charles Lindsay McAlpine, gave a speech at the Urban Land Institute, and a mayor of a small Colorado town came up to him and asked him, can the opportunity zone structure and the fund approach for public and private partnerships be used to build them a new fire station? And it's just a different application of the opportunity zone legislations to help municipalities and governmental entities get some projects underway. And I know we're running out of time, but I'll be brief. The benefits to the municipality or to the governmental entity is the speed of execution, not issuing bonds, revenue bonds or general obligation bonds, and quickly getting some of these projects completed that have been on the municipality's drawing boards for quite some time. To the investor, it's providing a shadow bond market return that's somewhere between 2 to 2.5 times the typical municipal bond rate. And it provides to the investor as some guarantee, as a municipality, depends on the state, of course, some guarantee that the payments are going to be made. And we lease these, the fund builds it, and the fund leases back to the municipality the asset over a long period of time, generally 20 to 30 years. That's our Opportunity Zone adventure for the last year and a half. And I think we have just a few seconds to take a question, or the only question I have is, how'd you get a full-page ad?
Yeah, I apologize about that.
That's
up close and personal, huh?
That's
wow. We do have a question?
I work in the space. I do kind of chronic control narrative. I'm in the middle of broker and development, so I'm working on projects. I have funds and I have developers. One of the questions that gets kind of lost in the legislation, a lot of people keep asking me, and I actually gotten several different answers. For small businesses that are already existing, how can they benefit from this legislation? Because we get told that it has to be a new business, but there's different, there's different groups that are saying they're doing it. So could you clarify that from a legal standpoint?
Sure.
Yeah, so the question was, existing businesses, can they benefit from the Opportunity Zone program? And I guess my question is, that existing business was around prior to 12/31/17, I suppose. And is it already in an Opportunity Zone?
It's in an opportunity zone.
And so it's not planning on moving?
No.
Yeah, so that is more complex. I believe it can get accomplished, whereby you take the existing assets possibly and either create some kind of lease structure with a related entity, or transfer the assets to a new entity with different ownership. Now, there are other hurdles to get around, but I've looked at this for a client of ours over the summer, and I think it's possible. I think there are, like I said, additional steps, and a conversation needs to happen with the small business owners, see what their expectations are to make sure that you're still, I mean, they still got a business to operate, right? So they got that concern, but to have that conversation of how do we still operate our business, we got a brand, we got a name, we got existing assets and employees, how do we take that all into account and still layer in the opportunity zone benefit, so.
Okay, so specifically, let's say you have a doctor's office, which is put a new doctor's office into an opportunity zone to serve an underserved community. Does that not count as a qualified opportunity zone project? Let's say I have a business out of practices located outside the zone. I want to create a dental office inside of the zone. Can that qualify?
So you have an existing medical practice outside the zone. Can we create a medical practice in the zone?
Under the same LLC,
Same LLC. So the one under the same LLC, I'd say no. You'd want to have that as a separate ownership structure, because at least 70% of your assets need to be qualifying. So if half their assets are in one office outside the zone, half are in the zone, you're not going to get there, right?
in that instance, would a conversion to a C corporation do the trick?
With a conversion to a C corporation, do the trick, and still house both practices in. Again, I'd say no. If you got one office location, which is 50% of your asset base outside the zone, I'd say no, that would not get you around that.
Creating a new LLC kind of fixes that problem.
Create a new LLC, yes.
And there's some tests that go with it, 50% of the payroll, 50% of revenues. So getting close and understanding those tests are critically important.
We do have a question that came in through Slack, surprisingly, so I'll address that. The question was, can a nonprofit or church organization invest in an OZ fund? Can these investments be commingled with other investment capital? So, like I said, to have that 10-year benefit, typically nonprofits don't pay taxes, so that might not be a driving concern for them. But if you have a nonprofit, yes, could possibly invest in an OZ fund. Nonprofits have their stated goals that they need to invest in the community. So if this is contrary to what their charter says, and that might disqualify them as a nonprofit, which is another conversation. But you can have qualifying and non-qualifying equity in a fund. So I'm sure Cityscope, if someone wanted to come and invest in Cityscope's project, they don't have a capital gain event, they just got $1 million after-tax money they want to invest. I'm sure they would take it, but that investor would have to know when that asset sells. Yeah, when that asset sells 12 years from now, they're getting taxed on it. So the qualifying equity owners would not get taxed.
Right.
One more question?
Going back to this question, say you had a doctor's office exists currently in an opportunity zone, they want to open now another office within the same opportunity zone. Does that change the game?
Yeah, it changes the game for sure. Now those new assets, the new
Assets within the opportunity zone.
right, but those existing ones, just generally speaking, would not qualify. So you'd have to, that existing practice, you'd have to get those somehow to become qualifying. Now, if the new office has a lot more assets, higher value, higher cost, because only 30% or only 70% of your assets need to be qualifying. Now, is that new building is a nice fancy building with a lot of new medical equipment that gets you above that threshold where 70% of the asset base is in the new facility and only 30% is in the old, and these are non-qualifying, you can possibly get there in that way. But if that's not likely, you're back to the 50-50, then you'd have to look to, I think, to peel off the ownership into a different LLC.
The spirit and the intent of the legislation was to be an attraction to bring businesses in.
To bring new businesses, right.
Right.
So I'd love to take more questions. I think we probably got to get the next panel on here. So I know I'll be here all day. I'm sure Mike will as well. So happy to answer questions during lunch or during one of our networking breaks. Thank you.
Thank you.